We found an unusual trade worth $112 million on Meta stock, also known as Facebook. And what's also very unusual about this is that Meta reports earnings in a few weeks on January 29th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish in buying Meta before earnings or bearish in selling Meta before earnings. Because as we all know, the rich have more access to information, including leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into the data as usual. As we can see here on the options time and sales tape, there were 2,485 contracts being traded here and 2,015 contracts being traded for these February 21st options at the 720 strike calls and the 635 strike calls. Now you may be wondering why these contracts do not match up in quantity. But that is because if we scroll down just a little bit, you can now see that there are 470 contracts here for these February 21st options at the 635 strike calls being traded at the same time, 11:38 at the 32-second mark. And so we have to add these contracts up. So 2015 plus the 470 is indeed the 2,485 contracts that matches up with this trade because they were being done at the same time by the same wealthy investor. And so if we calculate the trade costs for each of these contracts, we can see here that they paid $25.67 for the 635 strike calls, and they sold the 720 strike calls for $5.50. And so we subtract that out. So each contract costs $20.17 of debit. In dollar terms, we have to multiply by 100 since each option represents 100 shares of stock. And so it costs $2,017 per contract or trade. And when we analyze this trade some more on the option chain for these February 21st options, you can see that at the 635 strike calls, these were clearly opening trades since the open interest is much less at 711. So we know these were new opening trades. And you can see that we are also in the same position. POS stands for position. Green means buy, where we also bought these 635 strike calls. And we also sold the 720 strike calls as well, and that is why the position here is red. And so when we analyze this trade where they paid $20.17 of debit as we had just calculated earlier, on the risk profile profit loss graph where the x-axis represents the share price of Meta and the y-axis represents the profit loss, note the zero break-even point, and so when the lines are below it, it is a loss. And so when the share price goes down, it becomes more negative loss. And if it goes up, it becomes more positive gain because this is a long bullish trade. And we can confirm it on the Greeks here. We have a positive delta trade. Now, keep in mind, this is a high risk trade. We have a very negative theta. And because we have earnings coming up, it is also very high risk. And we use position sizing to manage our risk, where each position costs $2,017. We do not spend a lot of capital on these trades because we spend most of our capital on the trades with a higher chance of profit that does not have an earnings risk. If you are interested in the trades that have a higher chance of profit with less risk that we share on our website, then we'll put a link at the top here where you can find out more on how to gain access to the trades that wealthy investors are trading that have a higher chance of profit and lower risk based on stronger data analysis. Because not all of these unusual trades will be profitable. Some will be a loss, but as long as we diversify with higher quality stock picks based on this type of data analysis, then we can become more profitable in the long term. Now, we mentioned earlier that this was a $112 million trade. Now, how did we arrive at that? Well, if we take a deeper look at this trade, we can see here that there was actually another option trade over here at the 580 strike puts being done at the same time as those two other options. 11:38 at the 32-second mark. So these were being all done as a spread together. And based on our analysis, they were selling these 580 strike put options as a cash secured put, which means they are willing to own 100 shares at this strike price. And so we multiply that out and we get $58,000 of buying power required per contract that they sold. And since they sold 1,940 contracts, we multiply that out and we get $112 million that was required to place this trade. And so this is quite a significant amount of money to be trading earnings. But as we mentioned earlier, this is still a higher risk trade in comparison to the trades that we share on our website. And so if you want access to those stocks that those wealthy investors are trading or insiders that have a higher chance of profit, make sure to go to our website. We'll put a link at the top here where you can also gain access to better option strategies to reduce risk while increasing the chance of profit. Let us know in the comments below. Do you think Meta stock will go up after earnings? Or do you think it will crash down? As usual, please hit the like button, subscribe if you haven't. Take care and have a wonderful day.